They told you the crisis was over. They were lying. And the proof is now impossible to hide. Every major financial institution, every central bank press release, every carefully choreographed press conference from Washington to Brussels to Tokyo, for the past 3 years has delivered the same message with the same measured confidence. Inflation is under control, the banking system is stable, the debt is manageable, the soft landing has been achieved, growth is returning, the worst is behind us. They said it so consistently, with such institutional authority, with such an apparently unified front of credentialed expertise, that questioning it felt like choosing conspiracy theory over consensus reality. That is exactly what it was designed to feel like. Because the gap between what they were saying publicly and what their own internal models were showing privately has now grown so large that the real story is breaking through the institutionals, containment that was built to suppress it. Here is the dark truth that is finally emerging. The crisis was never resolved. It was postponed. It was hidden inside balance sheets that were never marked to market. It was buried under $8 trillion in central bank asset purchases that replaced genuine price discovery with artificial stability. It was papered over with deficit spending that transferred private financial losses onto sovereign balance sheets already straining under debt loads that have no historical precedent outside of wartime. The 2008 financial crisis was not fixed, it was refinanced. And the refinancing is now coming due at the worst possible moments, simultaneously, globally, at interest rates that the refinancing was never designed to survive. The real story is not about one country or one market or one institution. It is about the entire architecture of the post-2008 financial system. The interconnected web of sovereign debt, corporate leverage, derivatives exposure, and central bank balance sheet expansion that was assembled in the aftermath of one crisis, specifically to prevent the next one from being acknowledged until it was too late to do anything about it. That architecture is fracturing right now, and the fracture lines are visible to anyone willing to look at the data rather than the press releases. Let's establish the specific numbers that the official narrative has been carefully constructed to obscure, because the data is public, every piece of it. The lie was never about hiding the numbers. The lie was about the story. Those numbers were embedded in. Change the story and the same numbers mean something completely different. So here are the numbers with the correct story. Global debt, sovereign, corporate, and household combined, reached $313 trillion in 2024, according to the Institute of International Finance. That is 333% of global GDP. In 2008, when the financial system nearly collapsed, and the entire institutional response was organized around the urgent necessity of deleveraging, global debt was $173 trillion. 16 years of emergency deleveraging policy produced debt that is $140 trillion larger than the debt level that triggered the emergency. Not smaller, massively, catastrophically, historically larger. The deleveraging never happened. The leverage simply migrated from bank balance sheets to sovereign balance sheets, from visible private debt to less visible public debt, from markets that price risk, honestly, to central bank portfolios that do not price risk at all. The Federal Reserve's balance sheet peaked at $8.9 trillion in 2022. Before 2008, it was $900 billion. The European Central Bank's balance sheet reached $8.8 trillion. The Bank of Japan owns approximately 52% of all outstanding Japanese government bonds, a number so extraordinary that it represents the functional nationalization of the Japanese sovereign debt market, a condition that has no precedent in any developed economy in peacetime history. These balance sheets were expanded through quantitative easing programs that were described as temporary emergency measures. They have now been temporary emergency measures for 16 consecutive years. The temporary has become structural. The emergency has become the architecture. And the architecture requires permanent near-zero interest rates to remain functional, because at normal historical interest rates, the debt loads these balance sheets were created to support become mathematically unpayable. Interest rates are not at zero anymore. The Federal Reserve's benchmark rate went from 0.25% in March 2022 to 5.5% by July 2023, the fastest rate hiking cycle in 40 years. The European Central Bank went from negative rates to 4% in 14 months. The Bank of England went from 0.1% to 5.25%. Every major central bank in the developed world tightened simultaneously at a speed that the $313 trillion global debt structure was never designed to withstand. And the consequences of that tightening are now moving through the financial system with the slow grinding, mathematically inevitable momentum of a glacier that has already broken free and cannot be stopped regardless of what anyone says at a press conference. The U.S. commercial real estate market is carrying $1.5 trillion in loans that mature between 2024 and 2026, loans originated at near-zero interest rates that must now be refinanced at rates 3 to 4 times higher. The refinancing math does not work at current rates. It does not work at rates 100 basis points lower than current rates. For a significant portion of this $1.5 trillion, the refinancing math does not work at any rate that a functional economy would consider normal. The losses are there, they are real, They are sitting on bank balance sheets, primarily regional and community banks that hold 70% of all commercial real estate debt, at valuations that have not been marked to reflect what the assets would actually sell for in the current rate environment. The official story says the banking system is well capitalized. The unofficial reality is that the banking system is well capitalized at fictional valuations that have not been tested by actual market transactions. The U.S. national debt crossed $34 trillion and is accelerating toward $35 trillion at a pace that adds approximately $1 trillion every 100 days. Annual interest payments have crossed $1 trillion for the first time in American history, consuming more of the federal budget than defense spending, more than Medicare, more than any single government program except Social Security. A government spending $1 trillion annually just to service existing debt before funding a single government service is not a government with fiscal flexibility. It is a government in a debt trap where the cost of the debt prevents the fiscal adjustment that would reduce the cost of the debt. The trap is self-reinforcing. It tightens with every interest payment. And the people running the institutions that built this trap have been telling you for 3 years that everything is fine. The pattern of institutional deception about the true state of a financial system approaching collapse is not new. It is not even unusual. It is in fact one of the most reliable and regularly recurring patterns in the entire history of empires and financial systems. The specific mechanism, public reassurance maintained until the moment private collapse becomes publicly undeniable, has appeared in every major financial crisis in recorded history with a consistency that should be taught in every economics classroom on earth, but is instead almost entirely absent from mainstream financial education. Study John Law and the Mississippi Bubble of 1720. Law was not a fraud in the conventional sense. He was a genuine financial innovator, the architect of France's first central bank, the creator of paper money backed by colonial asset valuations, the designer of a system that genuinely believed its own premises. The Banque Royale issued paper currency backed by the projected revenues of French Louisiana, revenues that existed in the imagination of promoters and the ambitions of colonists, but had not yet materialized in actual economic output. The system worked as long as confidence was maintained. Law understood that confidence was the asset, so the institutional apparatus of the French state was deployed to maintain confidence, prosecuting public skeptics, restricting gold transactions, managing information flows to prevent the gap between projected revenues and actual revenues from becoming publicly visible. When the gap finally became impossible to hide, when enough investors attempted to convert paper claims to actual gold simultaneously, the collapse was not gradual, it was instantaneous. The Banque Royale's paper became worthless in weeks. The French financial system was set back 80 years. The institutional trauma of the Mississippi Bubble was so severe that France avoided paper money and central banking for nearly a century afterward, a financial conservatism that would eventually contribute to the fiscal constraints that produced the French Revolution. One bubble, one institutional deception. Consequences that reshaped French history for 70 years. The hidden financial force that connects John Law's Mississippi Bubble to the current crisis is the same force that has driven every major financial deception in history. The force is this: the institutions that manage financial systems have a structural incentive to maintain confidence in those systems that is stronger than their incentive to accurately represent the system's true condition. A central bank that publicly acknowledges that its balance sheet expansion has created systemic fragility destroys the confidence it needs to manage the fragility. A Treasury Secretary who publicly acknowledges that the debt trajectory is unsustainable triggers the bond market panic that makes the trajectory immediately unsurvivable. The honest assessment is institutionally self-defeating. So the dishonest assessment becomes the official position. Not through conspiracy, through the perfectly rational behavior of institutions protecting their own functional capacity. This is why every major financial crisis in history has been preceded by a period of official reassurance that in retrospect appears either incompetent or deliberately deceptive. It was neither. It was rational institutional behavior in a system where honesty is the most dangerous available option. The Federal Reserve's 2006 and 2007 statements about contained subprime exposure and resilient financial system fundamentals were not lies in the conventional sense. They were the rational outputs of an institution whose survival depended on the confidence those statements maintained. The same dynamic is operating today, at the same scale, with larger numbers, with less remaining capacity to absorb the consequences, when the gap becomes undeniable. The Weimar Republic's financial authorities maintained official reassurance about Germany's ability to meet reparations obligations and stabilize the mark until approximately 6 months before the hyperinflation that destroyed the German middle class, wiped out savings accumulated across generations, and created the economic desperation that made the political catastrophes of the 1930s possible. 6 months, between official reassurance and civilizational rupture. The gap between what the institutions knew and what they were saying was measured not in years but in months. And the people who trusted the official reassurance, who kept their savings in marks, who believed the stability the authorities projected, paid the price for that trust with everything they had built. Here is what the emerging real story means for the next 12 to 24 months in specific, actionable, financially consequential terms. The commercial real estate refinancing wall, $1.5 trillion maturing between now and 2026, will produce regional bank failures that the FDIC's current resolution fund of $121 billion, mathematically insufficient to cover at the scale required. When those failures begin appearing with the frequency that the maturity schedule makes inevitable, the official response will be another round of emergency measures, temporary programs, backstop facilities, reassuring language about systemic resilience. Watch what the measures actually do rather than what they are described as doing. If they involve any form of central bank balance sheet expansion, any return to quantitative easing under any name, it signals that the debt trap has closed completely, and the only remaining tool is the one that makes the long-term problem worse while solving the short-term crisis. Watch sovereign debt auctions in the periphery of the European financial system, Italy, Greece, Portugal, Spain, when auction demand weakens, when the bid-to-cover ratio on Italian BTP issuance drops below 1.4, or Greek bond spreads over German bunds widen past 200 basis points, without a corresponding German bunds widen past 200 basis points, without a corresponding German bund yield move. The European sovereign debt crisis, that was supposedly resolved by Mario Draghi's 2012 whatever it takes speech, is re-emerging. It never actually resolved. The ECB's balance sheet expansion suppressed the symptoms. The symptoms are returning because the balance sheet expansion is reversing, and the underlying fiscal conditions in Southern Europe have not improved materially in 12 years. Watch gold against every fiat currency simultaneously, not just against the dollar. When gold rises against the dollar, it can be explained as dollar weakness. When gold rises against the dollar, the euro, the yen, the pound, the Swiss franc, and the Australian dollar simultaneously, it cannot be explained as any single currency's weakness. It can only be explained as a broad institutional loss of confidence in fiat currency systems generally. That simultaneous appreciation pattern has appeared 3 times in the past 50 years. Each time it preceded a major restructuring of the global monetary system. It is appearing again now. Here is the final truth that this channel has been building toward across every video, every historical parallel, every financial pattern we have traced together. The crisis they told you was over was never over. The stability they projected was never real. The soft landing they celebrated was a controlled narrative, deployed by institutions whose survival depends on the confidence that narrative maintains. And the real story, the $313 trillion debt, the $8 trillion central bank balance sheets, the $1.5 trillion commercial real estate refinancing wall, the $1 trillion annual interest burden, the regional bank fragility, sitting beneath fictional valuations, is emerging now, not because anyone chose to reveal it, but because the numbers have grown too large to hide inside any narrative, no matter how carefully constructed. Empires do not fall because the truth emerges. They fall because the truth was always there, and the institutions built to manage it ran out of the capacity to keep it invisible. The capacity is running out. The truth is emerging. And the question that history always asks at this moment, the question that every citizen of every empire that has ever reached this point has eventually been forced to answer, is not whether the collapse comes. It is whether you saw it coming in time to protect what matters. The real story is finally emerging. The only question left is whether you are reading it or still believing the press release.